Welcome to the 14-day rule. You may have heard it talked about as the Augusta Rule. Now, I hear from accountants all the time that they don't know how to discuss things like this with their clients to get them excited about tax planning. For that reason, I'm going to take you through this strategy just how I would explain it to my clients to give you some ideas. Bottom line, be energetic, be honest, and be excited about the tax savings, and they will be too. Now, you can make money in real estate in a lot of ways, and a lot of it is tax advantaged. For rental property, you can deduct rental expenses, including losses, subject to the real estate passive activity rules, which we'll discuss in another course. Property tax attributable to the rental use of the home isn't subject to the new $10,000 limit on the state and local tax deduction. You can't deduct any interest that's attributable to your personal use of the home, but you can take the personal portion of property tax as an itemized deduction subject to the $10,000 limit. For non-rental property, you can deduct rental expenses only to the extent of your rental income. Any excess can be carried forward to offset rental income in future years. You can also take an itemized deduction for the personal portion of both mortgage interest and property taxes. In some situations, it may be beneficial to reduce personal use of a residence, so it will be classified as a rental property. Do you have homes in destination spots? Places where people flock during specific times of the year, Mardi Gras, spring break, how about sports championships or events? Maybe you own a home in places commonly used for filming locations. Section 61 of the Internal Revenue Code generally states that all income is taxable unless it isn't. In other words, unless there exists a specific exception in the code that excludes it, all items of income are taxable. Now, the Augusta Rule, which is named after the city that hosts a famous golf tournament, is arguably one of the most overlooked opportunities for realizing tax-free income. The Augusta Rule, also known as the Vacation Home Rules, is spelled out in IRC 280A. The vacation home rules offer a specific benefit to individuals like you who rent their primary or vacation homes for 14 or fewer days. Now, let's discuss the home rental rules. If you rent out all or a portion of your principal residence or a vacation home for less than 15 days, you don't have to report the income. But expenses directly associated with that rental, like advertising and cleaning, won't be deductible, but that makes sense, right? If you rent out your principal residence or second home for 15 days or more, you'll have to report the income. It's kind of like a cliff. Under 15 days, tax-free, 15 or more, taxable. But you also might be entitled to deduct some or all of your rental expenses, such as utilities, repairs, insurance. You get the idea. Exactly what you can deduct depends on whether the home is classified as a rental property for tax purposes, based on the amount of personal versus rental use. So this is called the Augusta Rule. The general rule concerning deductible expenses is that except as otherwise provided in 280A, in the case of a taxpayer who's an individual or an S corporation, no deduction otherwise allowable under this chapter shall be allowed with respect to the use of a dwelling unit which is used by the taxpayer during the taxable year as a residence. That is, taxpayers can't take a business deduction for a dwelling unit they use as a residence, their primary or vacation home. Now, of course, exceptions exist, especially for mixed-use properties. Think homes with a qualifying home office, those used for a taxpayer's daycare business, spaces in a principal residence used to store inventory, etc. Did you know that? Better go back and check all those home office deductions for your S corporations. Now, there are ways around it. The Augusta Rule itself is actually this Code Section 280A special rules for certain rental use. And that states that if a dwelling unit is used during the taxable year by the taxpayer as a residence, and that dwelling unit is actually rented for fewer than 15 days during the taxable year, then number one, no deduction otherwise allowable under this chapter because of the rental use of such dwelling unit shall be allowed. And the second part is that income derived from such use for the taxable year shall not be included in the gross income of such taxpayer under Code Section 61. So remember that 14 days income tax free? Here is how some savvy business owners who are very specific type of client can benefit. If you rent your property to a business, say for a corporate retreat, that business may require you to complete a Form W-9 so that business that is renting the property can comply with its information reporting requirements. Of course, you'd issue the owner a Form 1099 miscellaneous if required. Now, what happens when you own the business that rents your property? This is where the going gets good. When you use it for a business purpose, your business can rent out your home from you. Your business receives the tax deduction of the rental expense, while you escape tax on the income as the landlord. Now again, this only works for a very specific type of taxpayer. Take a celebrity, for example. They may rent homes for photo shoots at tens of thousands of dollars per day if they have a nice home. Their business can rent it from them and they can receive that income tax-free. So be careful with this. As with all tax law, you must have a bona fide business purpose for taking such a deduction. So think about this carefully. If you own a landscaping company or an accounting firm, why would your business need to rent your entire home from you 14 days each year? If you can answer that question with a valid business reason, enjoy your tax break. And if you can't, just list it on Airbnb. So long as you don't rent it more than 14 days per year, enjoy that income tax-free. I hope this helps give you some ideas on how to share this with your clients and get them eager about working with you to save tax. If you'd like more ideas on how to save tax and how to build in tax planning under advisory services in your tax practice, just visit the website on the next screen.